before we get started, and then we'll get into it. So first things first, obviously everyone here needs to understand that trading foreign currencies is risky. It's not suitable for all investors, and leverage can magnify profits as well as losses. And secondly, that the advice in this webinar is general advice only, and we're not considering your personal circumstances when we give any response or for any of the material here. So you need to decide if the information suits your needs. Pretty standard stuff. I'm sure everyone's seen that before by now. Yeah, so welcome everyone. Got clients from all around the globe. Got Mattia there from Italy. I recognise a few names as well from Peter in Christchurch in New Zealand. Got Steve with us. Steve's based in London in the UK. So this is a live and interactive session, so don't be shy with your questions. What we're going to do this time around is we're going to try to manage the flow of the questions a little bit. So if it's something that we're going to cover later on, then we'll ask you to hold your question to the end, and we'll go through it, and you can let us know if you'd still like to explore that topic anymore. I've got Landlands just down the road from me in Motueka, New Zealand. Yep, I've got record going. Okay, so it's 9 o'clock, so let's kick this off. So let's get started, Steve. So Steve, if you can start by telling us a little bit about your background, your trading career, how you got started, etc.
Okay, hi everybody. Well, it all started a long time ago, unfortunately. Back in '79, so you should all know that bank. I started as a trainee. I was very lucky to get in on the trainee scheme, and I ended up passing an IQ test. The bank was actually employing about 40 or 50 juniors per year at that time. How times have changed. I don't know if they employ anyone these days, but they were employing about 40 juniors a year, and we're all made to sit an IQ test. And I know for a fact that I didn't come top of that IQ test. I think I came 5th, but they liked something about me. I don't know. I think it's because I was a little cocky probably at the time, and they entered the top 5 people. I came 5th. And I eventually got the job as a trainee dealer. I had no clue what one of those was, but I got the job. I started off on the dollar depot book. They were really interesting times. I didn't know it at the time, but they were. Volcker was in charge of the Fed. Interest rates were in the 20s. Interest rates were moving 0.5%, 1% a day, and the markets were really starting to rock and roll. They were heady times, the early 80s. So I started off on the dollar depot book, where our head of trading ran that book, and then I eventually got moved on to forward Swiss. And our main job as a forward trader, we always had a forward mark trader, forward cable trader. Our main job was to buy cheap dollars or pay for expensive dollars for our dollar depot book. In other words, everything was focused on our dollar depot book. So the fact that we arbitrage, that was, in my case, that would be by using US interest rates to arbitrage into US rates. It was very technical, and it was a huge learning curve for me. After that, I was sent to Australia. So I was quite young then, in my early 20s. Australia was an up-and-coming market. The traders there obviously didn't have the experience of people in London, and I was sent to basically set up a Swiss book in Sydney. So I did that for a couple of years. I won't waffle on for too long, but I ended up going back to London and taking over the spot Aussie book. In between times, I went to LA. The Aussie was fixed at the time. You can read the bio there. I won't bore you all too much with it, but the Aussie was fixed. After it floated, We had the Banana Republic statement. We had the Aussie moving 7 big figures down in one day and then up 10 in the same day. So trading was highly volatile, and it made you highly sensitive to risk, and also to never trust the markets. So compared to these days of low interest rates and basically low volatility, people with my kind of experience are always very, very wary of what can lie around the corner. You never, ever, ever get complacent about what the markets can do to you. Hence, my trading style has always been a fairly cautious one, I guess. We'll come on to that later. I ended up going back to London, running the spot Aussie book, running the spot desk. Ended up going to New York, running the New York room and sales desk. And then I started getting old, I guess. I was getting into my 40s. I went to Australia to prop trade, as all old traders get put out to grass on the prop desk. And eventually I could see, as well as the bank, I think, you could see time coming to an end. And I obviously had to think on my feet about how to extend my financial markets career. And when you prop trade down in Sydney, you don't, as you guys obviously know all too well, who reside down there, you don't really have too much to go on. The markets don't move too much. Everything tends to happen in Europe or America. So you have to live a lot more on your wits rather than on flows. Having been brought up in London, everything's about flow, about order, about feel for the market. Whereas in Australia, I was lucky enough to work with a guy who was purely technically driven. And I learned a lot from him, apart from my own, what you pick up yourself as well. So my trading become much more focused on technical analysis. So I've used that and harnessed that with a very practical approach to trading in the sense that I understand what the charts do. I understand what the patterns mean. I understand what the charts are saying to me, but I don't treat each level as set in stone. In other words, if I look at a Fibonacci level and the level's at 50, I understand that people will be looking at that level and will place their stops behind it or their profits in front of it. And with that in mind, I put my own levels in, and we'll come on to that later as well. So I joined, I had an opportunity to join Dresdner Bank, and I joined there in 2001, and we had a team there who was focused was just solely technical analysis. We had a client list of about 4,000 or 5,000, and then we were encouraged by our clients, some of our big clients, to set up on our own, which we did. And I set up with Alan, who's still with us now, still with me now. We're partners, and we set up a technical analysis firm. Our clients have generally been institutional. We have dealt with retail in the past. We do deal with high net worths. We have managed money in the past, but it's become very, very onerous. Licensing, FCA requirements, and we've decided that we'll let other people manage money. We give advice, and we also have had a little move into the retail market through Sam. So we've been looking for some years for an alliance with someone, and Sam has become that person which has given us our introduction to the retail market. Hence us speaking to you guys here. What we hope to do is give you the same level of service that we give to our main clients, who include biggest hedge fund in the world, central banks, other hedge funds. We have pension funds in Northern Europe, particularly in Denmark. We have big institutional banks, clearing banks. Yeah, and that's our main client list. I think that covers the bio enough, Sam, is it?
Yeah, sounds good. Cheers, Steve. So next on to your trading approach.
Yeah, I mentioned earlier the fact that I've been involved in markets that have been very turbulent. I would hardly call these markets turbulent, like some people do. But I guess in this low interest rate environment, some of the moves we've seen in equities this year have been pretty huge. I consider myself a short-term trader. I like to know. I like to have a very clear idea in my head when I go to bed what I think the markets are going to do the next day. I tend to ignore what Asia does because it rarely does anything. In saying that, first thing I'll always look at is what the stock markets have done in Japan, Australia, and China, and in Asia in general. It's the stock markets I'm interested in more than what happens in the FX moves. So when I go to bed, I like to have a clear idea of what I think the markets are going to do. And most of my opinions over the last 10 years are focused almost entirely on what I think equities are going to do. That's my main focus. So we've had a massive in oil. We've had a couple of tries down in the in equity markets. My view was that maybe equities could go up today. And on the back of that, if I think that equities are going to go up, then I think there's a risk on trade. So that starts to influence what I'm thinking about the FX markets. Now, although I start at 4:15 in the morning, my job is completely focused on the charts. So I'm looking at those charts more or less 24 hours a day. So I don't need to get down here at 4:15 in the morning and start analysing the markets because I kind of know where they are. I kind of know what I expect to see. And it's not very often that I'm thrown off track. It does happen, of course. Sometimes there are some unusual moves. But usually I've got a pretty firm idea when I come down what I think the moves are going to be. So then my key focus is the stop and the target. When it comes down to news alerts or what's going to happen during the day, there are often so many hurdles you can put in front of yourself. Oh, I better not take the position because of this, or should I get on now, or should I leave it till later? I think you've got to have a set of rules for yourself and stick to those rules, and make trading as regimented as possible, to give you confidence to do what you do and not to provide yourself with obstacles. So even though I might know there might be a CPI number out of Germany or any economic stat could be released in an hour's time or 2 hours' time, you can't let that stand in your way, even though, of course, there are certain things that you can't ignore. You can't ignore employment figures on a Friday afternoon. You can't ignore central banks coming out with their interest rate policies, of course. And the other thing you have to do with all of those things, and I've said in my answers that I ignore all economic data. I do when it comes down to technical analysis, but of course I'm more than just a technical analyst. I also understand the markets and I understand their relationship with each other. I understand how interest rate differentials affect the dollar. So you can't totally ignore these factors. But what you have to do though is decide how those results are going to affect your markets. In other words, if you think the Fed are going to raise rates, what does that mean if they do? If they do raise a quarter, they say they're going to raise a quarter and they do, how's the market going to react? If they don't raise at all, how's the market going to react? You have to know all the scenarios that are out there and then react as things happen. Okay. When it comes down to the calls on a day, I do look at every single market that possibly there is. I even look at lumber. I look at orange juice. I look at the softs. I look at obviously the key ones: gold, oil. I've always looked at commodities because I've been an Aussie trader most of my career. So the Aussie does hold a soft spot for me. I actually analysed the yen, and when I analysed the yen, apart from what I said earlier about equities and risk on, risk off approach, I also analyse euro-dollar futures. So, for example, this quarter, which I did think that euro-dollar futures is going to rally, then it gave me a pretty good tip that dollar yen might come under pressure. In other words, US interest rates are going down, dollar's getting softer, and there's a good chance that dollar yen will go lower. We're going to come on to some examples of this week's calls and some of the daily calls this week, but I'll refer to euro-dollar futures as being a big influence on some of my calls this week. So what you see when you get your analysis in the mornings from us, you'll see a couple of charts and you'll see a call, I think the dollar's going up or I think the dollar's going down against the yen. But there's an awful lot of background that goes on behind it that you don't see. And so hopefully today you'll understand that there's a lot more goes into the call that you're seeing. And yeah, I'll wait for the next question now, Sam. I'm waffling on a bit there. Oh, you still there, Sam?
Can you hear me now?
Yeah, I lost you there, Sam.
Yeah, no, that was my fault. I had the microphone on mute and then started talking and didn't turn it back on. Yeah, so let's look now at your technical setup conditions.
Okay, I have my favourites, but due to the nature of our client base, we make a call across lots of different markets. Our clients vary, their time frames vary. Pension funds, for example, are only really interested in our quarterly calls. We have lots of data, and guys like yourselves are probably only really interested in our daily calls. You're not even interested in the weekly calls. We have some props that are pretty interested in the weekly calls. So we have to analyze each of those separate time frames. And like I said earlier, one of the hardest things for anyone to do is to enter a trade. There always seems so many reasons why you shouldn't enter a trade. So we set a time limit on when we enter. So we act like a mob, discretionary, but we'll enter our trades at 7 a.m. London time, unless it's a equity market or a fixed income market. In those cases, at the open. In this case, for European equities, that's at 7 a.m. anyway, and it's the same for bunds. So German fixed income, that opens at 7 a.m. as well. So that's why we use the 7 a.m. open, because it is the open for those markets for fixed income and for equities. Of course, this is not ideal. It's never perfect, especially often quite, oh God, I can't speak properly. Quite often what happens, you'll get a move between 6 and 7 a.m. in the direction that your signals are going anyway, which is a little bit frustrating for us. But what some of our clients do is that they have their own opinion, and that is very, very, very crucial for each of you to have your own opinion and not to rely on the input of one or two or three other offerings. So, for example, each of you should provide your own source of information, have your own opinion of where the market's going, and then look to someone like us, or of course I'd say look to us for technical analysis opinion, to back up your view. That's the way I would use our service. So if, for example, you thought that the dollar yen was going down this week, then you go to 3C analysis and see that perhaps that we're calling it down as well, and that gives you a little bit more confidence to put the trade on. But we put our call on at 7 a.m. And we take the call off at 1 p.m. We hope to really get the direction of the market right really within the first hour or two. We're hoping to catch that first move. If we haven't caught it in the first hour or two, chances are we're not going to catch it. The nature of the market has definitely changed in the last couple of years. The markets used to just go in one direction and stay in that direction, whereas it's been very apparent in the last couple of years that there's usually always a head fake to start the day off. So often our calls now are legged in. Originally, we go straight in fully to our limit. You don't know what that limit is, and that limit is up to you. You're managing the risk. But say I always think of it in thirds. Say I'd go in fully exposed. Say it could be 0.5% of your capital, whatever you decide you want to risk. But I always think of things in threes. So I'd go in with either 30 contracts if it was DAX futures. That's what I would have done 3 or 4 years ago, gone straight in with that amount. But these days I tend to do half of that on the open and then look to buy that first head fake. So if I'm bullish, I buy half of that allocation on the open and then wait for that move down first and then buy the other half of my allocation there. But of course, risk management is totally down to each individual person's risk profile. We provide the levels. The way I do things is that way. I don't like to go all in to start with. I like to leg in. I also like to leg out. So when it comes down to patterns themselves, then we have to look at the bigger picture first. So when I'm looking at any market, say for example, let's say for example the DAX, we know that there's been a massive sell-off, 1,400 points, something like that in January. So we know the backdrop has been extremely bearish open for DAX this year. So we know that's going on in the background. If you look at a weekly chart, you might see that the market put in a bit of a bottom 2 weeks ago, and last week. I'll come on to all these individual calls towards the end because I'll show you some charts. But if you drill it down closer, then you look at the weekly charts, you can see there's been a bit of an improvement. And then you come into the daily charts, and then you can say to yourself, well, we've seen a bit of an improvement. Is that improvement a correction to the big sell-off that's happened this year, or are things completely changing around? That's what the analyst has to say to himself. Now, in my head, I'm saying to myself, we've had a great sell-off, we've had a nice bounce, but this bounce is corrective. I'm almost certain it's corrective, and we're going to go lower again. So while the market's been moving up in the last few days, I'm saying to myself, we're going to go back down again. Now, we've seen that move back down this week, because oil's done exactly the same thing as equities. Equities are solely based on the back of oil at the moment. But of course, with last night oil having the massive move up, then you have to say to yourself, well, maybe we're going to have another leg up. So that's the basis of how you start looking at calls. You start with your long in the back of your head, no matter what market it is. It could be FX, fixed income, it doesn't matter. You look at the longer dated picture, we're bearish in equities. Closer picture on the weekly, we've been improving. Then you look down at you drill it down to the dailies. The dailies, okay, we've had a rally. The rally looks like it's running out of steam. Where's it running out of steam? Are there Fibonacci levels? I'll come up. I'm going to show you all this a little bit later. And then you say to yourself, right, on the day, all this is behind me. So what's going to happen today? Well, I think, okay, equities, there's a chance that people are afraid of missing out, that we've seen the lows. So the chances are they might step in and try and buy some equities today. So, so there's some of that's sort of the premise on the background. Then there's individual patterns. I've mentioned hammers. I love hammers. I love head and shoulders, reversal patterns, topping patterns, and I'm going to show you all of those in relation, particularly DAX, because it's been so big moves this year. And I'm going to look at the Aussie because it's pretty relevant to your time zone. And I'm going to look at dollar yen because it's just generally pretty relevant. So I'll come on all to those a bit later, Sam.
Okay, sure. Sounds good. So next one's probably going to be pretty quick for you, Steve. Fundamental setups.
I say I don't look at fundamentals, and as an analyst, as a technical analyst, I can't, because the technicals often, they're so right. Sometimes you can look at fundamentals and say, there's no way this can happen. There's no way. But it does. So I've learned over the years to trust my chart more than I trust the fundamentals. In saying that, you can't ignore them. So like I mentioned earlier, I always know when there's something coming out, and I always have in my head what I think traders will, how traders react to those fundamental conditions. So all in all, I generally, but I might add caution to my stuff. So one, I quite often don't run any. I wouldn't run anything into payrolls, for example. So we would cut stuff out, or reduce. Just put small exposure on if you know that something big's about to happen. That's it, Sam.
Right, thanks, Steve. Next is your specific entry. So how do you time your actual entry?
Yeah, like I said earlier, entries probably one of the most difficult things to do. So we always use a 7 a.m. open, or when the market opens. So for example, say we're doing the S&P, then we'd use the 2:30, the US Open. Like I said earlier, our clients often get our research before the open. They often trade our calls before the open, but we trade everything and record ourselves from the open. And for FX, of course, there isn't an open and close in FX, so we use the 7 a.m. open. If we're not sure where a market is at 7 a.m., it's not, I wouldn't say it's rare, but we will put a neutral call in if our signals aren't particularly clear. We nearly always try and put a direction on if we can. So when we look at our studies, and our studies involve momentum, RSI, the usual Keltner channels, Bollinger Bands, EMI, you name it. We look at all the indicators, and on a balance of looking at all those indicators, if there is a bias, we tend to try and use that bias, because a lot of our clients don't really care if we think it's neutral. We're basically no use to them at all. If they've got a particular trade or a client that has a desire to know where cable's going, it doesn't really do them that much good if we're telling them it's neutral or we're not sure where the market is. But in saying that, if that's the case, if that's what signals are saying, then that's what we show. But if there is any type of trend or any bias towards our signals, then we will show that. So yeah, 7 o'clock, that's the entry point.
Okay, thanks, Steve. And next one is trailing stop and stop losses.
Yeah, stop loss is the most important thing in any trade. Now, where I said the entries are a hard thing to do, if you make the entry 7 a.m., it isn't hard because you're almost forced into entering a trade, and that's what we are, forced into entering a trade. And we have clients who run buy positions on the back of all our calls. The people who are most vociferous actually aren't our hedge funds or our banks. They rarely come on and comment on our calls, for example. But our high net worths are on very, very regularly. It's their money, of course, and they're very vociferous about our calls, our stops, our entries, etc., etc. But the first thing I do with any trade is to work out where the stop is. Recently, of course, that's been pretty hard to. Today's a good example. When you have some really big moves in the markets, for example, in dollar yen the last couple of days, then it's very, very hard to get a sensible stop, because if you look at the technicals, all my stops on Fibonacci. So say we had a massive move down. There's two things you have to look at. You have to look at the massive move down from Friday's high. Obviously, at the end of last week, we had the Bank of Japan going into their easing policy. So we had a massive move up in dollar yen, and then we've had a massive move down this week. So the question is, the market's bearish. There's no doubt about that the last couple of days. But it's a question of where the kickback. There's going to be a bounce back up. There has to be. So where do you leave your stop? Now, I almost inevitably use a Fibonacci. So then I can use a Fibonacci from Friday's high. I can use a Fibonacci from yesterday's high. I can also use a Marabozu line, which I like using quite a lot too. And a Marabozu line is basically half the body of the candle. So yesterday's trading, it would be from yesterday's open to yesterday's close. Just take a 50% of that. That tends to be a really, really clever level of top in the market. So they're the things I'm looking at. What I tend to like doing, I like the 50% level as being an important level. So what I tend to do is use a 38% level is to sell a rally, in this case, if I'm looking at dollar yen, and I use it a 62% Fibonacci as my stop. So I straddle that 50%. Now, hopefully, that isn't going to be too big a pip stop. And quite often it is. And when clients say that to me, well, the stop's 60 pips away and it's way, way too much and I can't afford that. Well, you can afford it. Instead of doing 300,000, just do 100,000. So I think when you look at stops, you've always got to look at your capital and your percentage that you're allocating to the trade, not at amounts. And I think that'll stand you well as your trading experience grows and your amounts grow. When you first start trading, you start off really minimal amounts. I don't know what you do, $5,000 or $10,000, whatever it happens to be. It doesn't matter. It's all the same. But you've got to look at things as percentage allocation of your capital. And if you're willing to risk 0.2% of your capital if you're starting off with 10 grand as your capital, then you just adjust it accordingly. So you know, if the stop is 50 or 60 pips away and you think that's too rich, then instead of doing, you know, 5,000 or 10,000, just do half of that, etc. My stops are nearly always based on Fibonacci's. Occasionally, it's not. It might be a trend line. It might be something else. But I'll come on to that later as well. Okay, Sam.
Okay. Your exit strategy. Yep.
Exit strategy. I'm a very impatient. I'm a very impatient trader, and I'll say trader now because this isn't being an analyst. Your exit strategy, while I'll use Fibonacci's generally to get out of my trades. You know, managing risk isn't really what a technical analyst does. But for my exit strategy, I mentioned earlier that I like to get the markets right. I hope to get the markets right in the first hour or two. So when the markets open, I like to take a third off very, very quickly. I like to get my stop up to the entry point very, very quickly and have a risk-free trade and a stress-free trade on. So, you know, it's hard to quantify this just speaking to you now, but for example, in the Aussie, if the Aussie opens at 10 and I'm long, I'll quickly want to take 20, 25 pips off the table. I stop up fairly quickly because just to protect myself really. Any of you will have seen if you watch Sam's stuff or if you take part in Sam's stuff, that's what we do. We tend to take the first third off pretty quickly, hope for the second target to be met, and then if possible run the third and hope for the ball out the park on the third target. So that's basically how we take the markets off.
Next is trade management. This is probably pretty much covered already, but anything or more you want to add?
No, I think I covered that.
Yep. And this one, I think the next one, news events, we've pretty much covered too earlier. So maybe
we go on to
position sizing. Yeah.
Yeah, I've mentioned position sizing.
Position sizing. Yep. Anything else? There's a few things here you haven't talked about. In the risk management. So other risk management tools that you use.
Yeah, I think it's important to use daily, weekly, and monthly and quarterly drawdowns. I think it's important to know when you're on a bad run and they happen. And I think it's good to have a structure in place where you are comfortable that you can take a hit, because you are going to take a hit at some point. So I like to have limits on what they can be. I also think there are certain days when you trade better than other days. I think you should know what those days are, and it's very easy to keep a record. You should log everything down. You should log every trade down that you do. You should go back to it the following day and look at what went right and what went wrong and why. You should say to yourself, I always know that if I tend to go on little runs of getting markets right and then wrong. So if I get the market right 3 or 4 days in a row, So I've got a inverted commas feel for it. If I suddenly get the market wrong on the 5th day, then I pretty well know that the following day I'm going to have a very difficult day. So I act accordingly. I keep my exposure really small, and I'm very cautious about the way I manage my risk that day. If I've had 4 good days going into a Friday, it's very human nature to become frivolous on the Friday, and you can't help yourself, but you just naturally do it. So again, I act accordingly. I have rules in place to stop me being frivolous. Um, I think feeling under the weather, which I have been this week, then again, you curtail your trading. What other things? There are certain weeks that are more difficult than others. This is a particularly difficult week of the month, in my opinion. Payroll week is always a difficult week. The markets tend to freeze up a bit on Thursday or become, let's say, the volume becomes light, so the moves can become exaggerated. So you've got to take all those things into account when you're putting your trades on. Other things, if there's a massive move one day, for example, today's a good example for dollar yen. We had a massive move yesterday. What's going to happen today? If you go back and look at most really, really big moves, the next day tends to be a small range counter move day. So even though all the signals will still say the market's going lower, which they do on dollar yen, you have to be very cautious on after a big move. It sounds like it's just common sense, but you just do. You have to say it to yourself and record it and make sure you know why the markets are acting the way they do, because history always repeats itself. Human nature repeats itself. That's why charts are good, because they just constantly show humans reacting in the same way. So yeah, there's some of the things that I'd recommend on your risk management side of things.
Okay, great, thanks, Steve. And Mark's asked, is Friday a difficult day given weekend, month-end flows, etc.?
Yeah, I mean, yeah, anything that's kind of seasonal, month end always, yeah, it's always a bit thinner. So any market order is going to move the market a little bit more out of sync than it should be. My um, my favorite markets to trade are always the markets that are the most liquid. So if you said to me, and that should be one of your questions, well, what are your favorite markets? Then it would be DAX, Bunds, Eurodollar, the markets that are the most liquid. So when you throw in, the question is, are markets more difficult on a Friday? Then you'd say probably yes, because the markets are a little bit thinner. You also have the scenario where a lot of traders have put on trades for the week. They might be short dollar yen on the week, and then they don't want to run it over the weekend. So the chances are they're going to square up. So they're doing trades that don't necessarily go with the grain. Even more the case for the end of the month and the end of the quarter and the end of the year. So as soon as liquidity changes or dries up, which is why when I'm looking at equities, you can't do this as easy in FX, but you can in equities, constantly looking at volume and open interest. So you're looking at basically the commitment of traders and the volume that's going on in those markets at any given time. And what you ideally want, especially as an analyst, a technical analyst, is markets that are in high volume.
Are you there, Steve?
They say?
Yep,
Yeah, I
yep.
can hear you now.
Okay. Right. The final thing before we get into you showing your screen is the 3 most important things about successful trading, in your opinion.
Well, I've listed here discipline, composure, and it sounds corny, you know, being healthy and sleeping well. It is really important, you know. If you're hungover, if you're drunk, you might think that you can rule the world and stuff like that, but chances are that you won't. Now, I have seen some good traders trading very well when they're drunk, but generally, especially if you're prop trading, you kind of have to be disciplined and you have to stick to your rules and not let emotion take over. I see so many retail guys emotionally involved, and you can't be. You've got to be completely clear cut about it. You've got to structure your trade, put it on, have your stop, and really be really happy with it. And if you're stopped out, just tick it down to, as I say, go back the next day and check it, understand why you were wrong, and say, yep, the market's got the better of me there, but that was just one day. I'll get it right the next day. So yeah, discipline and composure are the main things as far as I'm concerned.
Okay, thanks, Steve. So one more question here, and we'll get into sharing the screen. So Trock has asked, do you take holidays during the European summer in that case?
It's funny, I was asked that one, the last one as well, wasn't I? Do I look like I need a holiday? Actually, I'm actually only 27. Do I look like I need a holiday? We do take holidays. Yes, we take 1 week at a time. We have 2 weeks off in the summer. We have we actually shut the company down for 2 weeks over Christmas. That's probably our favourite break. So we have a 2 week break over Christmas, and we have 2 separate weeks off over the summer. Yes.
Okay, thanks. So what I'll do now is I'm going to close the presentation. We'll just set up the screen sharing. So if anyone wants to take a couple of minute break, get a drink or whatever you need to do, then do that now, and we'll just set up.
You need to hit that icon, Sam.
Yep, that's the one. Okay, I can see that. Everyone who's here, let us know if they can see Steve's screen there, please. Okay, it looks like we're all good to go.
Okay. Right, what I thought I'd do is quickly check to see which markets I got right and wrong, which unfortunately I've got the DAX wrong. Okay, I'm going to start off with DAX because I mentioned it earlier. Can everyone see that? Sam, can you give me a bit of feedback just so I want to make sure you can hear me?
Yep, can hear you fine and can see everything there.
Can you see the charts, yeah?
Yep, charts are very clear.
I'm going to quickly run through DAX because it's interesting. And then I'm going to come on to some of the weekly calls and daily calls this week. Now, DAX going into Q1, we make a quarterly call, and anyone who gets our work can see that we're actually one of very, very, very few firms that were calling for a sell-off in Q1. And one of the main reasons, if you look at this quarterly chart, I don't know if you can see my little arrow around there, but one of the main reasons was you can see there's a trend of lower quarterly highs here. So when I'm looking at the markets, I can see that was a record high in April of 2015. And although people are still really, really bullish, especially going into the end of the year, we had this up quarter in Q4. You could see that the market still failed to end this trend of lower quarterly highs. So that was the market on a quarterly basis. So then, like I say, you look at the longer distance and then work your way in. So having looked at the quarterlies and thought, well, we're making lower quarterly highs despite the Q4 rally, we start looking at the monthly, and you can see we had this rally here in October and November, but it failed to take out the quarterly highs, like I said. And then in December, although the market had a failed sell-off, we were still ending a sequence of higher lows. So I thought to myself, going into Q1, the chances are market's going to have a little spat. So we called the markets lower going into Q1, and obviously
Steve,
in January.
Sorry, mate. Can you just move your chart to the left a little bit?
Yep.
Yep. It's just cut off. Yeah, there we go. That's right. Thanks.
Okay, so in Q1 we called the markets lower, and here you can see we had an immediate gap open, and then we had a test of the bull trend and a break of the bull trend. So that's the monthly chart. So then we move on to the weekly chart. What's happened on the weekly? You can see the big sell-off. You can see the low here. And what happened? We got a hammer 2 weeks ago. I mentioned it earlier. So we looked for a little correction up last week, and that's what we got. So then we move on to the dailies. So like I said earlier, when you have the big sell-off and then you have the move back up, you have to say to yourself, that's what the analyst has to say to himself, is this move up start of something new? Are people getting confident again? Are the markets going to go back up, or is this just a temporary correction? And we've been pretty firm in our view that it's just been a temporary correction. Now we've had some hammers, we've had the rally up, but the thing that's really dominating the background of that chart you can see there are the moving averages. You can see those moving averages, they're pretty grouped together and they're starting to fold over. So in my opinion, that the rally was never going to go further than the moving averages. So it was always a question of where's the market going to fail? And of course, we've got the failure. So now I'm going to move on to, so they're hammers that have worked. You could see the hammer back in the low in January. See that daily hammer worked into a rally. I thought yesterday's hammer would work into a rally. That hasn't been the case. So I'm wrong on that one today. But if we go on to another interesting chart, I'll show you Aussie yen. Hang on. Now this looks a busy chart. What we have in the Aussie and Aussie yen is something I referred to earlier. When I was US interest rates were. So for the view was the yen had come under pressure, and that's been the case. So we've had a big sell-off in Aussie yen going into this year. But what's interesting in Aussie yen, if you look at this daily chart, now I'm not saying I can give you a clear view on this, but it's an interesting chart and there's lots of things going on that I'm really interested in. The main feature being the bottom. If you have a look at this bottom, so this year's bottom, you can see we've got a head and shoulders formed, a reverse head and shoulders. So where my arrow is, there is the left shoulder, the head is below, and the right shoulder's over here. And classic to this pattern is formation of a hammer. So I like hammers, and that's a spring hammer. A spring hammer is where you got a long handle. So we've got a spring hammer, which is bullish. You've got reverse head and shoulders. But the point is, like with equities, we think that the rally is going to be temporary. It's a correction. The big move's still down. So where's this rally going to end? So we've broken the neckline, and look where we've stopped, bang on the moving averages. So we've stopped at the moving averages. Yesterday we've had a sell-off. Where does it stop? Very classic reaction back to the neckline of the head and shoulders. So we expect to bounce up from that neckline, and that's what we've had today. So today I've called the market bullish in Aussie yen, or I'm actually looking to buy the dip with that neckline as support. The other problem we've got in wanting this market to rally, apart from the moving averages, is this Fibonacci. So that's the Fibonacci from December to January. It stopped at 62%. So there's lots of reasons why the market can't go higher, but there's lots of reasons why the market could possibly go higher. So lots of things going on that chart, but from a technical perspective, really interesting. Reasons for it to stall and reasons for people to want to buy it. Overall, though, I think the market is in a temporary rally. So we're looking basically for the rally to fail eventually. I'll move on to dollar yen now. Oops. Hang on a second. Again, like I mentioned earlier, you look at the longer charts first. So what we have to note here is the massive rally that's happened in dollar yen since 2011. And we can see where that rally is stalled. It's pretty close to a yearly bear trend going back to 1990. That's a pretty important trend. So in the back of my head, I'm saying to myself when I'm looking at dollar yen going into Q1, we've stalled at a really important bear trend. What's the likelihood of the market reversing from here? Well, when I think of equities, when I think of US interest rate futures, I'm looking at a risk off. So chances are we might get some selling interest coming to dollar yen. So let's look at it a bit further. So we move away from the yearly and look at the quarterly. What's happened in the quarterly? You can see there's a real clear loss of momentum there. Unchanged closes, but the market stopped going up. And if I add some stochastics to that, momentum, that's momentum there, starting to weaken. RSI, starting to weaken. So all our strength indicators are starting to weaken. So big clues that the market might actually attract some selling. We're also posting lower quarterly highs. So going into Q1, my view was chances are the market may move lower. So we move away from the quarterlies and then start looking at the weeklies. And when you start looking at the highs, you can see up there in June and August, bit of a double top, bit of a weakening of the markets. And then when you drill it down to dailies, all this was happening with moving. Look at those moving averages. Absolute classic. All bunched up there, the 50, 100 and 200 day averages, all putting a top on the market. So even though we had this mass Friday, the fact is that rally is still right in the middle of those moving averages, and the chances were any sort of upset in the market, so with equities in particular, then it's quick going to unravel. So we've actually been bearish the last 2 days, but the harder question was today. It was really difficult to come in this morning, want to sell the market, even though it's just come off by what, 4.5 figures since Friday. So this comes down then to managing your risk and your size, because I really knew where I wanted my stop to be. I wanted to be just above 118.93, which is yesterday's Marubozu line. So you have to say to yourself, well, that was quite a long way away from this morning's open, and this morning's open for me was at 118.02. Then I had to say to myself, well, my stop's a big figure away, then really my size has to be a lot lower than normal. I'd like my stop only to be, say, 40 pips away. So if you're talking about at least just doing half the size. That's the way I would manage that particular situation. It's not by moving the stop down, because you're going to get stopped out. Well, in this case, you probably wouldn't have, but that's the way you have to think. Put your stop, make sure your stop's in the right place or exactly where you want it to be, and adjust your capital at risk. So I've left my stop today at 119.03, which is just above that Marubozu line. And then we're hoping for the markets to move back down to the lows. So at the moment, we're short of 118.02. We got 30 pips. Isn't bad. Yeah, has anyone got a chart they want me to look at, or are there any other interesting things you want me to look at? There's so many things I look at that are quite interesting. One of the things I love looking at, and if I can find it here, is I'm not on my usual laptop, so hang on a second. Something I like looking at, which is the FTSE DAX.
I've also had a request there for USD CAD as well.
Dollar CAD. I don't cover dollar CAD, but I'll look at it in a sec. Hang on. I'm just going to quickly show you the FTSE DAX spread. This is a little quirky thing that I think I'm one of the only people who look at. But I like looking at the UK against Europe, because it often tells me, gives me sometimes a clue of the direction of the markets. You can see here where the FTSE underperforms, you tend to get a sell-off in the markets. Hence that spread going down as the markets go down. But I'll go on to dollar CAD.
Also had other requests for CAD, Yen, and USD Swiss franc.
Okay, there's dollar CAD. Obviously, dollar CAD's influenced by oil, and you'd expect, with the big move up in oil, that the CAD would have appreciated. And of course, there it is. So you see the selling of dollar, buying of CAD. And what I do a lot of is overlay. I'd overlay that with oil. I won't do it here, but sometimes these relationships can be very, very strong, and sometimes they diverge, especially if there's an order in the markets. But when we're looking at dollar CAD, I don't cover dollar CAD, but yeah, you really be influenced by what's happening in oil. But if you have a look at dollar CAD itself,
sorry, Steve. Sorry, mate. Is it possible to move that chart slightly over? We can't see the right-hand edge. Yeah, that's
Okay, see
good.
it?
Thank
Can you
you.
see that?
Yep, that's all good.
Well, that's a monthly chart, and that is a pattern I really, really like. You see that candle there? That's called a shooting star. It resembles a shooting star, and what that reflects is bullish exhaustion. So you can see that the bulls have really, really bought it to the highs, and they've not been able to hold on to those highs. Hence, you got that really, really big tail or that shooting star pattern. That to me is a sign that the market's going to go lower. It might be temporary, but that market should go lower. So that's if I was looking at the monthly, I'd have said down. Then I go to my weekly charts. I can see that we've got a bit of an engulfing there. That candle is completely overlapping that up candle. That gives you another clue. So bearing in mind, in the back of your head, you've got your monthly shooting star. You've got a weekly candle that's engulfed that. And then you've got the higher lows that have ended. There's probably a trend there somewhere too. Where can we draw this trend? We can probably draw it across there. No, we'll draw it there. There's a trend there. That little trend's broken. So the weekly chart looks bearish, and then you go to the daily chart. Then it's looking a little bit overdone. It might bounce, but everything on that chart to me looks bearish at the moment. Probably contradict what Alan says, so I'll be in trouble for that. Anyone got anything else they want me to look at?
Alan's short today, I think. Yeah, there's a couple more here. I've got a few questions actually, so just answer so I don't lose them. So you're looking at futures charts. Are you there, or are you looking at spot price charts?
This spot.
This spot. Yep. Okay. I've got a question from Judith on Keltner channels, and we've got a question. So how do you use the Keltner channel? And got a question from Mark on. Oh, so you don't use the Keltner channel. So Alan uses the Keltner channel.
Yeah, I use Bollinger Bands.
Yep.
But you know, I always remember when Keating, I think, used the Banana Republic statement in my very, very early days. The head of trading in Commonwealth Bank of Australia was a guy called Art Brown. And I always remember him shouting, "What about the Bollinger Bands? What about the Bollinger Bands?" I mean, the Bollinger Bands are an absolute waste of time when a market is absolutely tanking. I mean, what Bollinger Bands do, I'm, you know, they're supposed, well, what they are is a move of 2 standard deviations away from the market. They do give you a level of, I wouldn't say comfort, a level of some, I guess, an area where the market may stop. So if I'm looking at, let's get the Aussie up, for example.
Maybe if you can do USD Swiss
There's
franc.
the Aussie.
Oh,
you want dollar Swiss? Okay.
yeah, I got someone who's interested, so you can just ask that question as well.
Okay, there's dollar Swiss. Daily chart. So you can see the Bollinger Bands there. You can see how the market does tend to back off from Bollinger Bands unless the market's trending. You know, if the market's trending up, which it has been, then it can hug the top of that Bollinger Band as the Bollinger Bands are pointing higher. Now, the way I'd look at it is if the market had a pullback, if I was thinking the pullback was corrective, then I'd look at the middle of that Bollinger Band, which is 2 standard deviations, and say, well, maybe the market will get support. But that level there, I treat it as a guide, but I don't treat it with that much importance, to be honest. Same with Keltner channels. Alan likes them a lot more than I do.
Thank you. And Mark's asked about, do you use the ADX along with the DMI?
I have looked at the ADX in the past. I don't. I tend to look at DMI a lot more when I'm looking at my 3-month and longer term charts. It tends to keep you disciplined and keeping it in a trend. In saying that, I look at DMI every single day. It's on my chart. You can see it down the bottom of this chart, if you can see it. And how I use it on a short-term basis is usually for if it diverges. I look at the relationship between the two lines, and if things don't seem quite right, then it might flag up that something might be amiss. So yeah, I don't use ADX.
Okay, cheers. Do you take notice of pivot points?
I do. Again, it tends to be on longer term charts. Like if on the Aussie yen, I know that I had one up for a while. Hang on a second. I'll use a pivot point like this, but I'm not married to them. You can see this. Can you see that Aussie yen pivot point from the 2011 high? You can see it's relevant, but you can see how there in August 13, that's quite a big move below it, and we basically sort of wobbled around it for a while, a couple of months there, which could have got you into a lot of trouble. In saying that, it provided support and it's providing resistance. So I don't ignore them, but again, I don't have them set in stone.
Okay, thanks. We've got a question on Euro Swiss franc. I know you used to cover this, but it's not something you cover so much now. Yeah, I'm not sure if the question is so relevant to your trading style, but it's what kind of add to entry would you look for after this type of run up? So if you're looking to add to this trade, how would you?
Yeah, I see what they're saying.
Yep.
A market that's just trending one way, where would you look to add? Well, obviously everything depends on your time frame. I'm a short-term trader, so that's a completely different answer to say you're a longer-term trader. Now, the level I'd look at here would definitely be a Fibonacci level. Going back to the Bollinger Band, see, I definitely look at where that blue line is and think about a dip into there. Well, I'd be looking at a Fibonacci straight away. I'd be looking at where. First of all, I'll go to a weekly chart.
Yeah, UK's 7 months into the trade, so it's a long-term view.
Right. Well, it's a weekly trade. 1, 2, 3, 4, 5, 6, 7. You can see there's a bit of a. Well, if we're talking pivots, let's put it in for you just to make you all happy. You've got some sort of base along there, and if I go Fibonacci, I'd start looking at a Fibonacci from here. Oh no, maybe from here. So you can see where this blue Bollinger Band line is comes in nicely around where the 62% is. So I'm thinking to myself, I wouldn't want to see Euro Swiss below there. I'd be very nervous if it got below there. If I was looking to add, I'd be thinking of somewhere around here, so 110.20. And I'm quickly going to switch this to a daily chart, but leave my Fibonacci there and tidy up the Fibonacci a bit. Yeah, so if I was looking at that chart, we're obviously trending nicely. I'd be looking to buy somewhere around there, 110.25. And then I'd be really nervous if it got below here, 109.20.
Yeah, cheers. Would you ever scale in on a breakout, or are you typically looking for a dip?
What do you mean scaling on a breakout?
So if it's making a new high, would you enter?
Yes. A lot of big traders do that, buy new highs. In that case, I would be thinking about you probably would have bought it recently. That's the sort of level you'd be looking to buy it there at 110.90. That break of the 50% and these old highs here. Yeah, I probably wouldn't buy it now. I'd have thought about buying it on that 50% there. Any others?
Yep. Okay, so what short-term timeframes do you look at?
Oh, my favourite chart's a 4-hour chart. I look at hourlies a lot because they're the moves I look at the 4-hour chart because to me that's a trading session. As a trader, I know how a trader thinks. He gets in the morning, the market's open at 7 or 8 o'clock. He trades till that's the way he looks at the markets. It's a morning session. Then he stops, has his lunch, and does whatever, and then he starts again in the afternoon. So his mentality is to break the markets down into those 4-hour sessions. So I like looking at my charts. You'll often see that my charts are 4-hour charts when you get them, and that is to reflect those trading sessions. So every candle to me then reflects what's happened to that trader during that session. I look at hourlies because I'm looking for divergence and momentum moves on. I'm looking for that 7 till 11 o'clock move. So yeah, 4-hourly charts are my favourite. I rarely look at anything below 1-hour chart.
Yep. Okay, and how long do you typically look to keep your trades for?
Shorts possible, 2 hours. I mean, we do have some strategic positions. That's not my strength. I generally hope to be out of the trade. If I put the trade on at 7, I really hope to be out of it by 9 o'clock. Generally, if it's longer than that, I've got it wrong and I'm legging in and I'm sweating on it, generally.
Mm-hmm. Okay, thanks. And a couple more questions here. Someone's asked about the CAD yen on the weekly charts, if you have an opinion on that. I saw some analysis the other day from Alan on it, actually. I presume it was from Alan the other day.
Yeah,
Come through. Yeah.
What did he say? I'll probably contradict him. No, don't tell me what he said. Let me make up my own opinion. Okay. Ooh, look at that big spike down there. That's a real big spring hammer. I usually like that pattern as a buy. So that's the monthly. That to me is just huge bearish exhaustion. Expect the reaction up, but we've not really had it. Weekly. Yeah, we have had a bit of a spike up. Probably corrective. Onto the middle of that Bollinger Band that we keep mentioning that I don't take seriously, but it does affect what I think really. First thing I do is put a Fibonacci on there. I know it's going to be around at 62. Yeah. It's bounced to exactly where you'd expect down, 52, and that Bollinger Band. For me, if you were to twist my arm, I'd say I like the spring hammer. Expect the bounce to be temporary. We've had the bounce. The bounce looks like it's failing, and I think it might go back down. Let's quick look at the daily. See the way it's popping over there. Yeah, I think it's going to go back down.
Okay, thanks, Steve. Right. So this one related to one before I also ask it now. Do you close all your positions before you go to bed?
Yes.
Yep. Okay, and we've got another one here. If you select a trade and it hits the stop loss, do you have a strategy to enter the trade in the opposite direction?
Yeah, that's an interesting question. When I was trading, I used to. I've learned a lot in my years, and if I get a trade wrong, I tend to stop out and forget it, leave it, don't touch the trade again. Yeah, that's it now.
Yeah, thanks. Okay, and I have a couple of questions for you, actually. So in the last one, we talked about some of your war stories, and one was you talked about your biggest loss in a day. Thought if you could talk us through that one again, that'd be interesting.
It's a couple of war stories. I always remember. Well, my favourite story is probably. It's not the worst day I had, but it's when I first went to New York, and I was sent there to run the FX trading and sales desk. So I'd been there 2 or 3 days, and the guy I was taken over from was a guy called John Hall, who now works in America. He's an Aussie guy. He's from Sydney, and he was actually going back to Sydney. So I was taking his place in New York, and it so happened on my third day there, the spot Aussie trader had a day off. So John said to me, "So do you fancy doing the Aussie?" I said, "Not really." He said, "Well, I think this is a way to get to know everyone." So I sat down and started trading the Aussie, and it booted off really, really quickly. And I remember I could tell you about the sizes that we usually had, but I was about 25 long, and the market had gone down about 30 or 40 pips. And I can't remember the actual big figures and stuff like that, but I know that the Aussie was trading at around 70, 80. And Sachs called up, Goldman Sachs New York, and said, "Can I have an Aussie in 10?" And with the market at 70, 80, I went 20, 30. 50 points lower, he went, "Yours." And I thought, oh my God, I'm dead. So I just went out and sold 100, I think I sold. I can't remember. It was absolute carnage. But at one point, I was down nearly $1 million. And by the end of the day, I think I've lost $25,000. And I remember walking out the room and some young American guy going, "That was big, man." And I went, "No, it wasn't. I lost $30,000. So, sometimes you watch these movies, Wolf on Wall Street and stuff like that, and you think, that can't be true. But it actually was. And, when you look back on those days, some of the crazy stuff was unbelievable. I remember when I was first in Australia, I mentioned to you when I first went to Australia, I was only about 23. But they had a guy doing the Aussie there, a guy called Tom Upton. He was a fantastic Aussie trader, but a complete lunatic. Heavy into drinking, heavy into playing poker. And I remember he took on Westpac one day and he had nothing behind him at all. He just kept selling the market, and Westpac kept buying it, buying it, buying it. And I was sitting there shaking my head going, how's he going to get away with this? He's got nothing. There's no clients behind him or anything. and eventually Westpac just folded. It was just like this massive game of poker taking place in what's supposed to be a professional financial markets arena. But these are the sort of things that just happened, you know. And back in those days, in those 80s, it was just crazy stuff. I guess the regulators are looking back on it now and seeing if everything was truly kosher or not. Yeah, but there's some funny times. I also remember another story when I first started, and this isn't my story, but I always remember when I first started, I was a trainee and I went to a lecture, and it was given by Barclays. He tells the story of this is before they had direct dealing machines. Basically, everything, it was either done by telex or it was done on the phone. So the standard amount of the trade at the time was, I think, £1 million. Anyway, this bank in Europe somewhere called up Barclays and said, "Oh, could you quote me a cable in £1, please?" And the guy at Barclays went, "Do you realise it's 6.15?" And the bloke went, "At 6, I'll give you £1." Of course, Barclays was telling the guy it was the time and the markets are closed. But because your word is your bond, Barclays actually stood by the deal. Now, that might be a myth, but I've always loved that story. It's 6.15. At 6, I'll give you £1. So that's it. My war story, Sam.
Yeah, thanks. Yeah, I always remember a war story from the 80s. I got told, guy Gavin White, I don't know if you know him, so Aussie trader. His first day they had Mr. Ed on television, and he was told, your job is when Mr. Ed neighs or whatever Mr. Ed does, you got to buy, and all the traders had to start buying Aussie. And when he said something else, he had to yell out sell, and then all the traders had to start selling Aussie, and that was how they decided what direction to take for the day.
It doesn't put us in a very good light, does it?
Yeah, a bit different these days, I'd imagine. Yeah. Now another question I have for you is a couple more from clients, but I just want to. This one I thought was something that was quite interesting. We discussed it briefly the other day. We're talking about one of your lessons that you've learned over your years is to trade with the trend. So, wondering if you could talk about that a little bit.
Yeah. Well, I think it's really human nature that when, for example, let's go back to dollar yen, when the market craps out the way it has, the initial reaction of any human being is to buy it because it's cheap. But I think the longer I've been an analyst, and the longer actually I've worked in isolation. In other words, I don't work in a trading room. I don't have to listen to what other people say. I've only got my own company. Then the more I've realised, if something's cheap, it's cheap for a reason, and the chances are it's going to get cheaper. So, whereas when I was in my, if the market had a big move down, I'd be thinking, "Oh, is this the time to buy?" I don't think that at all now. If the market goes down, I think this is probably the time to sell. So I think that's something that you have to take on board, and it's a very difficult thing to take on board when you first start off in the markets.
Yeah, I see a lot of traders in the retail space. They're always contrarian. They're always looking to trade against the trend.
I think there is a time to be contrarian. I think there's a time to be contrarian. I do like the style of some contrarian traders, but I think you have to wait until the market is mature before you become contrarian. I think that's where it's really important to look at open interest if you're looking at equities, and the commitment of traders if you're looking at FX. If the market is 100% committed to being short, then the chances are might be the time to buy it. That's the only time I'd be contrarian.
Okay, cheers. Yeah, that's an interesting one. I think one of the guys here, Peter, was asking me about the commitment of traders report as well, and how to use that in the trading, whether it's a contrarian indicator or something you can look to go with the crowd and follow the trend.
I think the idea is the way I always look at it is getting on a train or a bus, and the chances are that the market's going down. Say, for example, equities are going down, oil's going down. The chances are you aren't going to buy it at the lowest point. Just accept the fact that you're not going to buy it at the lowest point. So don't try to. That's the key fact. Don't try and pick the bottom. Wait for the bottom to find itself. Wait for the market to rally a bit. Wait for it to get to the first stop and maybe even the second stop. And then if you can get on at the third stop and then go to the fourth, fifth, sixth, seventh, eighth, ninth, 10th, and then get off at the 11th stop before it gets to its final destination, leave something on the table for something else, then you're probably going to do yourself a pretty good job. So constant thing I'm getting from retail people is, shall I buy it now? Shall I buy it now? No. I have to, why try and catch a falling knife? Just let the knife carry on falling until it stops and turns round. And that's another very key point to bear in mind. Don't try and find the low.
Yeah, definitely. Yeah. Okay, so we got a couple more here. Mark, I'll answer your question in a tick myself. Jack has asked, do you have a strategy for important news and data such as NFP tomorrow? So sort of know the answer to that one will be you'll stay out, but if there's anything more you want to add?
What can I add? No, I won't have a position going into it. No.
Yeah. And Peter has asked, how many short-term trades do you have on at the same time?
Well, that's a good question. I like to have a balanced portfolio. So, these days things are very much risk on, risk off, and a lot of the trades are pretty much the same. So more recently, I think there's not really that much need to have more than one trade on at a time. In the past, it was pretty good to have a balanced portfolio. In other words, you might have a commodity currency on, you might have a major currency on, you might have an equity trade on, you might have 3 trades on, and if something went well or something went bad, then they might mitigate each other. But you tend to find these days that it's either all on or all off. So it's pretty pointless having, say, short equities and also being short dollar yen, short Aussie, long Swiss. It's all pretty much the same trade.
Yeah. What about if you've got a position? Because I know you like to get to risk-free pretty quick. So what about if you've got a position that's at risk-free? Would you then be looking for another trade, or just going with the same one?
These days, like I say, in the past, it's always been worthwhile to have a bit of a mixture on. But these days, for me, it's just one decent trade is all that you need. Quite often, it then becomes a question of how much risk you want on the trade. It tends to be a safer trade to put an Aussie trade on rather than an outright equity trade on. So it depends on how much risk or how confident you are in the trade. If I'm really confident that it's risk off or risk on, then I inevitably do DAX. It's just what I do. If I think it's risk off, then I might maybe I'll sell some Aussie, or it depends.
Okay, thank you. Got one more question here from John. Do you have a preference to bullish or bearish markets?
Yeah, that's a good question.
Yeah.
I'm old school Aussie. I love a bearish market. I think all of us who brought up trading in the 80s, especially if we traded the Aussie, just love being short. I love being short. I love being short of equities. I love being short. Short.
Okay, well, that's interesting. I thought you'd say the opposite, actually. Okay, so that looks like all the questions. If anyone else can just type in the questions there, any other questions they might have there before we wrap up. Got something. Mark has asked, can we get access to 3C analysis through FX Renew? So I'll just explain that a little bit for the people that don't know the complete picture. So basically what Steve and his firm does, so Steve and Alan, they provide a report each day, or a number of reports covering, it's about 24 markets, isn't it, Steve?
Yeah.
Yeah, and half of those are Forex markets. And what we do each day at FX Renew is we take what we think is the best trade. So I'll talk to Steve and we'll decide what we think is the best trade for the day, and then we'll put it up. And then we'll manage it. And then, but what other clients can get if they want is they can get access to all the Forex calls in particular, or if they want access to the equity calls. I know Steve's very good on the DAX, for example, as he's talked about. You can get that too, and that's part of our professional subscription option. So that's available for anyone if they want to take a look at that. So just reach out to me and I'll help get you set up with a trial. It's pretty good the way we've structured. Well, Steve's been really generous. So in the past, Steve mentioned it's about for the current clients, for the hedge fund clients, etc., and bank clients. The service costs 500 Great British Pound. So through us, you can essentially get access to it for 300 AUD. So it's quite good value. So something there that if anyone wants to have a trial, then just reach out to me and we'll set you up. Particularly like it, there's a couple of things that I particularly like about it, actually. So one, if I'm trying to decide what to trade for the day, then you've got the view there, and the accuracy rate is very high. You've got a view to confirm your view, to give you confidence in the trade. Another thing that I've found very, very helpful, for example, is picking turning points and trends, or telling when a trend ends. So my nature is just to keep going with the trend. But what is very useful is, and I've noticed, is often when a trend is ending, and right near where it's ending, just through the way Steve and Alan do their analysis, they're able to actually let you know that it's ending very quickly. Now, I mean a longer term trend. The USD CAD was a great example. So Steve and Alan's calls turned bearish right near the top. It was excellent. It's a good way to know that the trend is ending. Lots of other ways you can use it as well. There's education videos and things available on the 3CA site, as Ashish is just mentioning, and all that is available as well. So if you want access to that, Ashish, just reach out to me. I'll get the logins and everything set up for you so you can log onto the site. So what some traders will do is they will log in to the 3CA website, and that gives them early access to the calls, because what they do is they load up the calls into the site, and once they're all up, then they get sent out via email. But obviously some of the calls are going up earlier than others, so it's a good way to get in the call a little bit earlier, because as Steve mentions, often it's moved a little bit by the time it actually gets emailed out. So pretty good option there if you've got a shorter term time frame with the professional subscription option. Right, Steve, is there anything else you want to talk about, mate, or we can wrap it up?
I apologise. I'm not very well this week, so I probably don't sound very enthusiastic today, and I apologise for that. But if anyone wants to ask either me a question or any of those questions that relate more to Alan, I remember the Keltner channel question, then honestly, feel free to email Alan, or me with any question or anything. Don't understand. One thing, when we present our work, when you look at our stuff, our analysis, what you'll see are charts that are very, very clear, and labeling that you can generally understand. In other words, levels where the stop should be and the target should be. What you won't see is a lot of garbled lines and technical jargon that a lot of analysts put on. So, what I hope you'll understand is that there's a lot of experience and time and effort that have gone into making the calls. Not guaranteeing that they're right, but what you see is a clear presentation, and there's a lot of work that's gone in behind it. That's all really. And if anyone's got any questions at all, then honestly, feel free.
Yeah, cheers. And what I'll actually get people to do is there's a forum in the workshop forum. There's a section there for questions for Steve and Alan. So if we can add them in there, I'll pass them on to Steve and Alan. They can answer, and then everyone gets the benefit of the response rather than one person. Everyone can learn. So that would be great. Yeah. I think that's it, Steve. Thanks a lot, mate. I know you're a bit under the weather today, so very much appreciate you taking the time.
No, I appreciate the fact that it's dinner time for everyone, and I know what it's like with a crazy house full of kids or whatever you've got at home. So I appreciate you listening.
Yeah, cheers. Thank you.
Okay, so sign off, Sam. Shall I?
Yep. Let's wrap it up. I'll chat to you later on.
Thanks, Sam. Thanks,
Yeah,
everybody.
cheers, mate.
Bye-bye.
Bye-bye. Thanks, everyone.